Hello, this is Rich Lowry of Park Edge Advisors, and this is our fourth quarter update. The theme this quarter is called Sleepwalking into Recession, something that I get the sense that many investors are doing and something that we certainly don't want to join them in. Oh, there we go. We'll start out with the unofficial sentiment check, and this is unofficial in that it's not based on any data, but as I talk to clients, I get the sense that we fall into one of three buckets. The first one, where the majority of clients are, is stay the course, patience is going to be rewarded. I would place myself in that category. But there are two other categories that I want to address. One of which is that the soft landing, that we're headed for a soft landing, not a recession, not a hard landing. And if that's the case, that implies that the bear market was last year, the recession was maybe last year, and is the market bounce that we've seen the first half of this year indicative of a new bull trend? And I'll walk through some facts behind that. Third category is, it's been so long since any of us can recall getting 5% risk-free on T-bills. Why don't we just put our money in T-bills and be done with it? Now, I agree with part of that. T-bills, I do think, are the most attractive asset out there on a risk-adjusted basis. What I disagree, though, is that when the recession does come, that's going to force the Fed to cut rates. The 5% is going to become 4, then 3, then 2. And meanwhile, inflation is going to remain sticky at between 3 and 4%. And if you own an asset paying 2 when inflation is 3 to 4, that's a melting ice cube. And an investor that thinks that that's attractive, by the time they figure out that is no longer a good deal, the opportunity that the stock market, we think, is going to offer at some point is going to be gone. So I'd like to address each of these. Let's take the soft landing first. Every recession has two phases. Phase one is when things tighten. Phase two is when things break. Every time there's a lag between phase one and phase two. It varies cycle to cycle. Every time we hit that lag, the market bounces. On average, it's an 11% bounce. That lag, when the market bounces between phase one and phase two, almost always gets dubbed the soft landing. So this is no different than any other cycle in that regard. If we back up to the first quarter update that we had beginning of this year, we said there's room for the market to bounce simply because we were at that point between phase one and phase two, where the market usually does bounce. We had some favorable liquidity dynamics that added to that picture. Namely, the Treasury was sidelined from issuing any new debt because of the debt ceiling. That removes a negative lever of liquidity, because when they sell debt, they put bonds into the system, they take liquidity out of the system, and the fact that they were up against a debt limit and couldn't issue any more debt removed a negative source of liquidity. And then they ended up having to spend their bank account down from over 800 billion down to, I think, 150 billion. And that meant that they had liquidity from their bank account that they pushed into the economy, and that was a temporary positive. So, given that we were at the lag between phase one and phase two, given that we saw liquidity was going to be temporarily positive, we expected the market to bounce, but we didn't position for it on the basis that 11% average upside is not enough to compensate you for the downside that usually comes along with phase two. The last point on this is the bounce really was weak. If you take the 7 stocks connected to artificial intelligence, the so-called AI7, the remainder of the S&P, 493 companies, are down. If you take the Russell 3000 and subtract those same companies, 2,993 companies were down. So it really wasn't much of a bounce. And we still expect that we're going into a recession. Here's a chart that shows what a soft landing looks like. So in the case of 2012, we had a soft landing. In the case of 2015, we had a soft landing. What you see is the trend, growth is above trend, it falls below trend, stabilizes, doesn't go negative, and that's a soft landing. Again, in 2015, we were above trend. We fell below trend, we stabilized, didn't go negative. That's a soft landing. If all you look at is a composite of coincident indicators, this may look like a soft landing. That's where the soft landing narrative comes from. But when you look ahead and incorporate leading indicators would be in black. In the 2012 soft landing, they never went negative. So they were not even saying recession, they were confirming a soft landing. In 2015, you can see the black line goes down, temporarily goes negative, but bounces right back. So leading indicators were not calling for a hard landing. And then here's where we are now. Leading indicators are way out here, and that is indicative of a soft landing. If you want to expand the number of variables that you look at, here are a host of other recession indicators. And you can see in both the 2012 and 2015 soft landing, none of them said recession. All of them said soft landing. That is what a soft landing looks like. That's different than the financial crisis in 2008, where every single metric was saying recession ahead of the recession. In the tech bubble, all but two were saying recession ahead of the recession. And in the current cycle, all but two are saying recession ahead of the recession. So if you focus on the economic cycle, if you focus on the data is basically saying hard landing ahead. The only thing calling for a soft landing are media headlines, and that's nothing new. So here is a collage of past newspaper headlines where each time you hit that lag between phase one and phase two, it gets dubbed a soft landing. So down here you have Ben Bernanke himself in 2007 saying that we were going to have a soft landing, and obviously we know what happened in 2008. And then over here you had the tech bubble in 2000. That was being called a soft landing, and we know what happened there. And again, all it is the lag between phase one and phase two. If you want to track the current cycle, a nice acronym to use is HOPE. H stands for housing, O stands for orders, P stands for production, E stands for employment. Our colleague at Cantor Fitzgerald popularized this, and it does represent the sequence. Housing is always the first to go. It was the first to go this time. It's negative. It's not rebounding. Orders are the second thing to go. They were the second thing to go this time. They're negative. They're not rebounding. Production is always the third thing to go. It was the third thing to go this time. It's negative and it's not rebounding. The only thing left is employment. And it does look like employment is getting close to triggering. So if you had to draw this up in a textbook, this is what the cycle would look like. The aggregate economy here determines recession. That would be this cycle here. And when you hit the red star, there's your recession. It pays to back up and look at things that lead the aggregate economy. So to give an example that most people would be familiar with, if you want to track new home sales, so not me selling my house or you selling yours, but a newly constructed home, if you want to track new home sales, you would back up and track residential construction, which you might find as the cyclical economy. And if you want a lead of that, you would track building permits. So you have to get a permit first, then and only then can you build, then and only then can you sell a house. That sequence is mechanical. It can't be shuffled around cycle to cycle. So if you follow building permits today, it's going to tell you something about residential construction with a lag. And if you follow residential construction units under construction today, it's going to tell you something about new home sales with a lag. Employment is the last to go. So here we separate leading employment from coincident employment. Coincident in blue, leading in red. So leading is negative, and it's a matter of time before the blue line goes negative, and that will be the commencement of the recession. A different way of looking at each of these series Oh, and by the way, this is the most recent report that came out Friday. So we ticked down further and it's hanging in by a thread. We're a 0.1% above going negative. If you track leading and coincident against the pattern of the last 5 recessions, I don't see anything here that says there's anything different about this cycle. So leading employment today is following the typical script. If you use the last 5 recessions, I don't see any behavior there that's unusual in any way. And same with coincident employment. It pretty much is following the same path of the last 5 recessions. So nothing unusual there. The fact that continuing claims is above the recession threshold indicates that we're not likely to see a turn, a bounce back in leading employment, that's likely to remain negative. If we go back to the June update of last year, June of 2022, we said recession was on track by year end and into the first quarter of this year. As you can see, the economy did follow the path down that would have put it on track for recession in the first quarter, but then notice the flatlining. The flatlining has kept it hanging in by a thread. The more that it flatlined, the more that it extended the time frame for recession. And just because the recession hasn't hit by now doesn't mean that it's not still on the way. On a rate of change basis, that flatlining doesn't really help the quadrant determination, whether the economy is in quad 1, quad 2, 3, or 4. The flatlining is indicating kind of nothingness, which is another reason why we've been so defensive. But let's dig in to what's causing the flatlining, because if we can isolate what's causing it, and then find the things that are going to determine when that turns, that should give us some pretty good insight on when to expect a recession. There are 2 tools that you could use or more, but I'm just giving you an example using 2 to measure the lead time between phase 1 and phase 2. So this one looks at the inversion of the 10-year yield versus a 3-month yield. The typical behavior when it comes to yields is that the longer you're willing to tie your money up, the more you should get paid for it. That's the normal state. The unusual state is for short-term rates to exceed long-term rates, and that happens when the Fed jacks up interest rates. So that's a very typical response that you get in phase 1 where the Fed tightens. And if they tighten so much that the 3-month yield exceeds the 10-year yield, then you can start the countdown. In the first recession here that we show, it took 12 months from the point of inversion to hit recession. Sometimes it happened as soon as 6 months, other times as long as 17, with an average of 12, and currently we're right on 12. So this is saying that the recession could be here basically any week, any month. Another is to look at the peak in the leading index, and from the time the leading index peaks, count the number of months before we hit recession. On average, that is 16 months. And you can see we're well above that currently. So, this is going to tell us a little something about why is this taking so much longer this time compared to previous cycles. If we drill down, we'll find that it is residential construction that accounts for the lag. If residential construction was following the path of prior recessions, it would be closer to the black line. But you can see up here, it has been just hovering above, it's just been hovering above the 0 line. And the more that flatlines, the more that is allowing the overall economy to flatline. So it really becomes a measure of when does this start to turn down? And then I think the rest of the dominoes are going to fall in place for the recession to be here. So drilling down further, we see that units under construction are taking that much longer to complete. They're currently taking 16 months, and on average, it's a little more than 11 months. The fact that it's taking units longer to complete is meaning construction workers are remaining employed longer than they normally would at this point in the cycle. But once units are completed, then we would expect employment tied to residential construction to turn negative, and that's going to be the catalyst to get the rest of the employment cycle going negative. So if we take a look to see whether there are things filling up the pipeline, so as these projects that are taking longer to get completed actually are completed, is there enough in the pipeline to replace that and elongate the employment cycle? And this is showing units under construction is basically flat. So there isn't a lot going in the pipeline. And if we back up 16 months ago, this is the point at which these permits were pulled. So the permits 16 months ago coincided with activity that was at the peak of the cycle. And you can see since then, permits have collapsed. You may notice a little bit of a bounce from here to here, and it does raise a question. If that bounce continues and gets stronger, maybe that could save the cycle and kind of keep the soft landing hope alive. But a leading indicator of permits has reversed fairly sharply negative. So this red line here that's showing a little bit of a bounce is the same as this blue line, except it's smooth. It's a 4-month average. A leading indicator of that is the National Association of Home Builders Housing Market Index, and that's turned down sharply recently, which indicates the red line is likely to follow it down. So we're not seeing the kind of permit activity that suggests residential construction is going to pick up. There haven't been new units put into construction, which leaves us with the outcome that as units are completed, we would expect the employment cycle to turn. We are beginning to see signs that phase 2 is emerging. So again, phase 1 is when they tighten, phase 2 is when they break. Rising bankruptcies are a sign that things are starting to break. And recently, bankruptcies have gone vertical. It's not the height of the line. I don't want anybody to confuse the bankruptcies we've seen year to date as being comparable to the financial crisis. It's completely different. Financial crisis, it was large banks that had tentacles into every corner of the economy, and that represented systemic risk. Here, it's a different composition. So I'm not trying to equate one with the other, but the direction. What we're seeing now is not this kind of somewhat normal behavior. It's just straight up. So this is telling me that, a sign that phase 2, is fast approaching. In terms of what's next, it's just continue to follow the cycle. We're at a point as we move into phase 2 where real interest rates have been rising. So nominal interest rates have been going up as inflation is falling, which means real interest rates have expanded quite a bit. That implies that risk premiums for stocks are going up, which is the same thing as saying valuations are about to get compressed. When that happens, stocks go down regardless of earnings. And when stocks go down, the layoff cycle is going to commence. And then that has to feed on itself. There'll be a certain amount of energy that has to dissipate once that reinforcement mechanism kicks in, where as people are laid off, they spend less. And as they spend less, that's less income to another business, which to offset that slowdown, they have to lay off workers. And that has to play out. So the bottom line is the recession is still on track. Buying opportunity, I think, is out there. We just have to wait for it and be patient. I know I've sounded like a broken record over the last 12 months, but I do think that just because the recession is not here doesn't mean it's not coming. It means it's just been postponed, but the factors that have contributed to it being postponed look to be dissipating. Some catalyst from here, the big catalyst post July 31st, that's when the Treasury came out and said, we are going to issue a boatload of new treasuries. And again, when they issue treasuries, they take liquidity out of the system. It's been a tale of two halves so far, where the first half, we got a bounce in the market. Since July 31st, all risk assets are basically down. October 31st was the update for the fourth quarter, where the Treasury said we're going to issue the same amount of debt, but we're going to issue more Treasury bills that don't drain liquidity the same as bonds would. Markets have had a little bit of a lift since then, kind of a relief rally, but all the Treasury is doing is kicking the can down the road. They can't keep issuing Treasury bills forever. They have to issue bonds. And it's a matter of time before that adds up to another move down in liquidity. Other factors, you had student loan payments restart. I've seen reports that show that 2/3 of above trend spending is attributable to student loan payments being suspended. The auto worker strike is getting resolved. But the auto companies saw it coming a mile away. They overproduced cars last year, which means they're likely to underproduce cars this year. So you have a little bit less spending due to the student loan payments. You should have less production, given that autos were overproduced last year. Another government shutdown on the horizon. Obviously, the tragedy in Israel happening at the same time that Russia and Ukraine are still going at it, while China is on the sidelines waiting to make their move on Taiwan. If we had an overall bullish viewpoint, which obviously we don't, and then you introduced all those geopolitical risks and tensions, that might be enough, to want to take risk down. But meanwhile, we have a fairly bearish outlook just based on the recession alone. And even if you removed these geopolitical risks somehow, we would still have a pretty bearish outlook just based on the cycle. Weak demand is trending. So companies release earnings, they do a conference call with analysts and investors. Technology gets used to go through the transcripts. And the trending term this time around is weak demand. And we're on pace for a record, and the date only goes back to 2000, but that's a long enough period of time that weak demand is being mentioned at a higher frequency than any time since 2000. And here's our current positioning. So, basically we have 92% where it's safe. 70% that we have in T-bills. T-bills are the safest, most liquid asset on the planet. Last ones that we bought were 5.4%, and we're getting paid nicely, to be patient. 21% in the US dollar index and gold, which are traditional safe havens, and those should kind of weather the storm well. The current quadrant setup that we're in is quad 3, and that's what gives rise to having 6% in commodities. And then we have a small piece in the other category where we have a manager who is doing an absolute return strategy. So similar in terms of what we're trying to do, but they have other tools and strategies that they're employing. This is likely to remain intact for the time being. But what's likely to happen next is when the recession arrives, we would look to reduce the T-bills and add to bonds. So when the recession gets here, it's going to force the Fed's hand to start cutting. The current rates on T-bills that look good today are going to start declining. And we would look to lock in good yields by extending maturity. So that would be a likely pivot that we would make as the recession arrives. And if we get any kind of bounce between now and year end, we would look to add to the inverse funds. Inverse funds, as you may recall, do the opposite of what the underlying does. So if we think the market is going to go down, we can buy an inverse fund and try to make money from that decline. So if we do get a year-end bounce or any kind of meaningful bounce, our view is that the cycle is ultimately going to win. The cycle is going to prevail, and any bounce we do get is going to fail. And that is going to give us an opportunity to add to inverse funds. And then the real opportunity is going to be in the middle of the recession. So we've been waiting patiently, trying to protect capital as much as we can for the opportunity to add to equities in the middle of the recession. That I think it is well worth waiting for. There aren't that many opportunities or that frequent of opportunities, to invest at the bottom of an economic cycle coming out into an expansion, which should be a new bull market. And the returns coming out of that are good enough that we think they're certainly worth waiting for. So with that, I appreciate you watching the video and look forward to talking with you to see what questions you may have. Thanks and have a good day.